Konuğumuz dünyada yeni finansman alternatiflerinden bahsedecekler. Hem deneyimlerinden hem de dünyadaki diğer modellerden bahsediyor olacaklar. Öyleyse kendilerini davet etmekten mutluluk duyarız. EY, Orta, Güneydoğu, Avrupa ve Orta Asya bölge yapılandırma liderini davet etmek isterim. May I invite dear Raj Apte to the stage, please. Welcome.
Thank you very much.
Welcome, please.
Good morning, everybody, and thank you very much for making the time. My name is Raj Apte, and I'll be speaking in English. If people would like to have a translation into Turkish, there are live translations available to translate it into Turkish. I'm here to talk to you today about new finance alternatives in the world. By way of background, I'm a partner at Ernst & Young, EY, and I head up the restructuring practice over 31 countries. That's Central Europe, Southeastern Europe, that's including Turkey, and as far as Russia. I have over 22 years of corporate finance experience. I joined EY 4 years ago, and I have a team in London and Prague who covers this broad region. I've been fortunate enough to advise over the years on more than $250 billion worth of transactions. And what's interesting is that in many of them, I've actually brought in fresh capital. An example, back in 2009, I advised a company called Heidelberg Cement. They had 8.7 billion euros worth of bank debt. They had 4 billion euros worth of bond debt, and they were left for dead. At the time, you might recall, back in 2009, construction industry was on its knees, and cement was not in demand. So bankers said, Raj, who should invest at all in a company like Heidelberg Cement? Nobody's buying their products. But they missed one important point. Every business, well run, with the right strategy, can be successful. And in the low point of a cycle, a well-run company invested into can give you outsized returns as the economy recovers. And Heidelberg Cement was a well-run company. They had extremely good systems, very good corporate governance, and a cost base and resource base that would be successful going forward. I raised for them 4.4 billion euros worth of equity, 2.2 on secondary, 2 billion on primary, and raised $4 billion worth of fresh bonds to take out the bank debt. Before EY, I was at Lazard, an investment bank, and before that, I was a banker at Morgan Stanley. And right at the beginning of my career, I was a finance attorney, dual qualified as an English solicitor, and also a German Rechtsanwalt, a German attorney. I speak fluent German. All these are many different restructurings, and right now I'm advising with my Turkish colleagues in EY Turkey on 8.1 billion euros worth of deals. And this is how we work. I have a team of 11 people in my core regional team based in London and Prague, and I work very closely with my Turkey colleagues on transactions in Turkey, Metin Bey, Ilhami Bey, who's in the crowd here, and others of the team of 15 additional professionals in EY Turkey working alongside us. And at the bottom, you see some of the deals we're advising on, $2.2 billion transactions, right through to 4.8 billion euros worth of debt transactions. And I've been doing that for quite some time in the Turkish market. What I'd like to share with you are the range of new money options. There is a very broad spectrum of capital available globally that can be brought into Turkey with the right structures and with the right basis for that money to come in. I'm going to walk you through a little bit of the broad spectrum of instruments that you see. We start on the bottom left-hand corner. Super senior financing. That's first priority debt that can come in the waterfall. It's the highest priority of debt, but it's the easiest money to get in because for the creditor, it's the lowest risk. Then you have senior secured debt, which can come in many forms. It's not just loans. It could be finance leases, it could be factoring facilities. There are many forms of secured financing available. Then you have senior unsecured debt, and that overlaps a little bit with the high-yield bond world, which is a very, very deep market. And what I would say is this: I think Turkey is a fantastic economy because it has huge potential. Geographically, you span east and west globally. Well-educated, young population, thinking internationally, the potential is there. And it is so important to be able to tap that potential. And capital markets globally is one of the easiest ways to access that capital if you can open yourself out to it. And the conversation earlier around that I'm very supportive of, because those countries that access international capital markets dominate globally because they have the funding to fulfill their dreams of growing internationally and expanding. Mezzanine debt is subordinated debt. It comes in many forms. It can be loans and bonds, but it's subordinated to the senior secured. Today I'll talk a little bit about hybrid instruments. And in those hybrid instruments, I'm explaining how those structured instruments can also be a valuable financing source in Turkey to achieve the returns that lenders would like to have for riskier asset classes, but also be defensive enough for those lenders to want to give the money. So hybrids are a very valuable thing that people should think about doing more with. Preferred equity and equity, different forms of equity. So I'm going to show this in a slightly different format to help you visualize how it's done. If you look on the bottom left, there we have our super senior debt. That super senior debt is done either through an intercreditor agreement that says the lenders and other stakeholders agree that if there was a problem, the first people to get paid are the super senior lenders. It could also be statutory. Some of you may have heard of, in the US in Chapter 11 restructurings, a thing called DIP financing, debtor in possession financing. So when companies are struggling and nobody will lend them money, if you create a legislatively protected way of new money coming in on a super senior basis, people will lend. And there are many institutions who would love to lend fresh money into challenged situations because they can lend on a super senior basis. Then you got senior secured debt. That's the further away you are from the asset, senior secured. Then you got senior unsecured debt. Above that, mezzanine or subordinated debt. These can be loans or bonds. Doesn't really matter. Depends on how you structure it. You've got hybrid instruments and preferred equity. And what's important is even with an equity, you can do so many different things. You know, Class A shares, B shares, pref shares, different voting rights. There's a world of structuring. And if people are open to thinking of innovation, open to thinking about how international capital can be tailored to the risk profile of the situation by coming up with some level of complexity, but tailoring it to the need, you can access capital. I have, and I'll give you an example today of a structure that I have done in a live situation where I was able to raise multiple hundreds of millions of euros worth of financing from funds in London through a structure which I will show. Pricing is really important because everybody says to me in Turkey, how much will it cost? And the answer is, it will cost what the risk profile requires. Cheap isn't always the answer because you may get nothing if you just think about pricing. But you can structure things to make it feasible. You can have cash pay interest or PIK interest. PIK interest is payment in kind. You don't actually pay cash, you just roll up the debt. It compounds. You could pay as you can interest. You can structure it through upfront fees payable to the lender. You can structure it through commitment fees. So, okay, I'm not going to borrow your money now, but for keeping the commitment open, I'll pay you something every quarter or month. Exit fees, don't pay me now, but if I exit, I sell the business, you'll give me some extra fees to compensate me for the return I'm looking for. OID, original issue discount. When you issue money, I'll give you 100. You want to borrow 100, but I'll give you 96 today. I have a 4 that I keep, which is my original issue discount. Doesn't cost me anything because the lender lent the money. But again, there are many different solutions, and warrants, which I'll talk about today, equity warrants are an instrument that says you, the holder of the warrant, have a right to a return in whatever form it might be. It could be equity or others, but warrants can be a really good way of getting extra value. If I move on to the sources of capital and the pricing that involves, it's so important to see pricing in context. Everybody says, Raj, can you just give me something that's cheap? I've heard US dollar, euro financing's cheap. I say, yes, it is, but it depends on where you are in the risk profile. And you layer onto that the level of country and other risk you have. If you look on the top left-hand side, I talk about country risk, and I talk about the fact that developed economies like UK, Italy, Germany, they borrow, their risk is very low. The sovereign debt pricing for 10-year bonds is low, below 1%. If you go to emerging economies, China, India, Brazil, it's more like towards the 6%. And Turkey, at the moment, has a very high risk profile of 11%. There are many different reasons, but it makes it expensive if you are Turkish with sovereign risk to have the cheapest available pricing. Currency risk is another factor where when you look at bond pricing, I've not used bank debt pricing, looked at 5-year averages, Turkish lira pricing has a price, if you can get euro dollar, ideally matched to your revenue, then it does work out cheaper. But people seem to forget the bottom through things because they seem to forget about, well, what's their real rating? Any company can be rated, doesn't have to have bonds. You know, am I a AA issuer where I can, or single A where I can borrow for below 1%, or am I a lowly rated entity where B minus S&P rating, I'm going to be more around the 6% rating. And then the final thing is leverage, net debt to EBITDA. How much debt do I have to the earnings I generate? When you are highly levered, between 3 and 6 times, yes, you're going to pay 4, 5 times, 6 times the cost of capital for somebody lower levered. So it's so important to see those factors. But through clever structuring, even with country risk, currency risk, ratings, and leverage problems, there are people willing to lend capital. They just want a return commensurate with the risk that's being presented. So where do I get money from? Obviously, banks, both in Turkey and in Europe. You've got Chinese and other banks willing to lend, and some US banks specifically. But actually, they have a much more conservative approach to lending. It's a very simple business for them broadly. They can come up with structured instruments, but it's a relatively straightforward world. The people willing to lend money on risky things are funds. Funds like KKR and others who will lend money, HPS, which is an offshoot to JP Morgan. They have, sitting in London alone, $1,000 billion worth of dry powder ready to be deployed globally. That's $1 trillion. I know all these funds, I know them personally very well, all the senior investors, the portfolio managers. And they say to me, Raj, can I lend into something? And I have a lot of deals where I'm actively seeking capital. But they have different return hurdles. For the debt profiles that they have, they need something somewhere in the 9, 10, 12% return hurdle. Doesn't have to be cash pay interest. It could be any form of return. And together with banks, because banks have a very valuable role to play in markets, both bank debt and bond debt issuance and other equity instruments, these people can play a part. They understand complexity. So I'm going to focus for a moment on hybrid instruments because this gives you a sense of why complexity is important. Because you can't solve difficult problems with simple. You can't go with a heart problem and just say, can you give me a pill? They may need to do some very complex surgery or put a heart stent in to fix you. So hybrid instruments are just one example. I'm just giving this as an example of why addressing complexity with a structured instrument can provide solutions. So why would I use a hybrid? What is a hybrid instrument? Well, it's part debt, part equity. It's got debt-like features and equity-like features. But equity is, for many people, investors, a too risky thing. It causes issues. So the hybrid avoids those issues. It allows you to have the upside of equity growth, because equity exponentially grows as businesses recover, but without some of the issues. I look on the top left-hand side where it says, at 12 o'clock on my little diagram, avoids equitable subordination. All that means is, if you are a lender of debt, and you are also a shareholder, you can, in certain circumstances, be equitably subordinated, forced to the back of the queue, like equity, and that's a bad thing for lenders. So hybrids can avoid that risk. You don't need to worry about distributable reserves. You're getting a coupon, you're getting an interest like a debt instrument. So whether or not there are distributable reserves, doesn't matter. I get paid. It avoids shadow directorship. I will lend to you $100 million, but I don't want to be taking the risk, the fiduciary risk, of being called a director of your business. I just want to lend to you. If you look around 2 o'clock on the diagram, optimal regulatory. So in many countries where I advise, I've been talking to central banks about how hybrid instruments are a solution for the banking system generally. And those regulators have been very open to this. They've said, you know what, these are the kind of things that will help us get out of trouble. Because banks, if they're willing to do some of these things, can de-risk or reduce the debt, but keep returns that will get them a chance to earn their money back. Maintaining debt seniority. If I'm lending you money into a risky situation, I need to make sure that I can get a return, risk profile, that's not going to mean that I'm back of the queue. I'd like to be secured and be prior in the capital structure. So if it all goes wrong, I can be like a lender. And if it goes well, I'd like to get the upside. Around 5 o'clock, you'll see existing shareholders. They can retain the equity. If you're a family business, somebody lending you a hybrid instrument doesn't want to own your business. You keep owning it. They'll lend you an instrument that allows them to get the economic upside, and they'll want some covenants to control you don't do crazy things, but equally, the equity remains with the owners. You can tailor-make the instrument to the situation. So the beautiful thing about hybrids is you can really tailor-make it to the exact profile that you have. It can be tax efficient. Remember, debt interest is usually deductible. You can deduct it before you get to your taxable profits. And you don't need to worry about dividend tax, because I'm not paying a dividend. I'm paying a coupon under my hybrid instrument. Finally, liquidity and tradability. If Turkey can open its capital markets, and I'm a big supporter of that, you will get significant funding coming into the country. Again, commensurate with the risk profile, but it has to be tradable. The minute I have an instrument that's tradable, it means I lend you the money, and if I don't like the risk, I can sell it in the capital market, so I'm more inclined to lend you the money in the first place. I can get out of the position quickly. So liquidity is an important factor of opening up the ability and willingness of people to lend. Also, you can have optimized terms in these things. It's just very clear. It's a good way of doing things. Now I'm going to go through a couple of case studies just to show you how you do it. There are many, many ways. This is a deal that I've changed the numbers and changed the situation, but this is a real situation that I've been advising on. Imagine a Turkish group, and the numbers are all made up. 400 million euros worth of debt. EBITDA is, call it 50 million. So I'm 8 times net debt to EBITDA. I'm struggling. The business is only worth 7 times. So equity worth 0. My debt is up to there. I've got some debt going into my subcos. Here, some are valuable assets, some less. And I've got some money in my holding. I'm a Turkish group. Now, most international lenders today, in the current macro political climate that is facing Turkey right now, they are not able or willing to lend directly into Turkey. They struggle with it. Some funds just don't have the ability to do it. Some, from risk appetite, they say, not now. 5 years ago, yes. Right now, I'm wait and watch. But you can get the money. It is possible to get the money. I'd like to raise for this company, in my illustrative example, and again, my real-world example was many hundreds of millions, which I got non-binding offers for from some of the funds I showed earlier. You structure it through using innovation. Here's a Dutch holding group. I have in this Dutch holding group, I've created them above my holdco. And what I do is I put in 300 million of super senior debt, fresh money. 250 pays down my 400 million euros worth of debt, and 50 is new money to help grow the business.